The return of President Donald Trump brought not only political expectations but also a significant boost in morale for the crypto market, while many countries, including China, are actively testing BDS, the digital legal tender controlled by the central bank. Trump chose a different direction. He announced he would never allow BDS to appear in the United States, citing concerns about privacy and excessive government intervention. But what's more noteworthy is that he doesn't oppose the entire process of digitizing currency. On the contrary, a few days ago, the US Treasury Borrowing Advisory Committee (TBAC) published a report, which was made publicly available on the official website of the Department of the Treasury. TBAC is the agency responsible for planning, or more professionally put, advising the Treasury Department on borrowing strategies. The report centered around the topic of digital money, with a specific focus on stablecoins, the role of the US dollar, and their impact on the American financial system. While the report covers many areas, the most notable point is TBAC's apparent implication that stablecoins could potentially be swapped for short-term Treasury bonds T-bills. To put it simply, people from all over the world can indirectly own US Treasury bonds by using stablecoins through issuers such as US, PUS, etc. As long as those stablecoins are pegged directly to the US dollar on a 1-1 basis. This means individuals could gain exposure to US debt instruments while still holding stablecoins for use in the crypto market. The report from TBAC could help the Treasury better understand both the opportunities and risks brought by stablecoins, allowing for adjustments in borrowing policy, monetary management, and the structure of the financial market. With the stablecoin market projected in the report to reach nearly $2 trillion by 2028, could stablecoins become a new source of capital inflow for the US government? And will the crypto market benefit and continue its upward momentum in the coming period? Trump shows an open attitude towards stablecoin, a special type of cryptocurrency that is not as volatile as Bitcoin, not as rigid as BTC, but is steadily making inroads into the global financial life. Stablecoin is a strange kind of money. It doesn't have the potential to make you instantly rich overnight, nor does it threaten the current financial system with defiant statements. It simply replaces slow, expensive, and limited money transfer methods with something faster, cheaper, and more accessible. If you've ever transferred money from the US to Asia, you may have clearly seen that an international transaction through the SWIFT system, born in 1973, still takes 1 to 5 business days, with fees ranging from 25 to 50, not to mention difficult to control layers of intermediaries and opaque exchange rates. In 2023 alone, the world lost tens of billions of dollars just sending money. Meanwhile, stablecoins like USD or D can perform the same transaction in a matter of seconds, regardless of time zone, regardless of nationality, and almost for free. No bank needed, no office hours needed, no one's approval needed, just a device connected to the internet. In a world spinning with the speed of technological development, governments have been forced to change. They may no longer see Bitcoin is the #1 enemy, but they clearly still maintain a cautious attitude towards a type of asset that is too difficult to control, borderless, with no one behind it, and that cannot be shut down by a single decree. In this context, stablecoin emerges as a point of balance, not as wild as pure crypto, but also not as constrained as BDS. They light the intersection between the old and the new, between stability and innovation, from a convenient solution for transactions. Stablecoins are now becoming the underlying layer for a new global financial system, where the US dollar exists not only as paper money or bank accounts, but also as tokens operating 24/7, decentralized, permissionless. Potentially, Trump saw that stablecoins are not just a haven from volatility, they could be the bridge to a comprehensive financial overhaul, a leap forward without having to tear everything down. So how are stablecoins being used? What types of stablecoins are there, and which models have failed spectacularly? The story of trading volume surpassing Visa. The collapse of Terra, the new generation blockchains that no longer charge fees, all are opening up a very different future for something called money. Let's start the video right now. This article is part of the content series of the typically stablecoins are known as the USD on the blockchain. Although the majority of stablecoins currently pegged to the US dollar, reflecting its central role in global trade, the market is expanding to include many other pricing units such as Euro, British Pound, Japanese yen, gold, and even real assets like carbon credits. Each type reflects a specific need: local payment currency hedging, or creating a new layer of value storage. However, the US dollar remains central. The first stablecoin, Tether or US, was created in 2014 by the Bitfinex team with a simple model: deposit 1 USD in real life to receive 1 USD on the blockchain. Although suspected of lacking transparency for years, Tether has thrived and by February 2025 had reached over $142 billion us in supply becoming the largest stablecoin in the world from their stablecoins began to diversify not only in terms of technology but also philosophy. They can be divided into three main types. 1. Fight-back stablecoin is pegged to traditional assets. This is the most common and also the most readily accepted form of stablecoin by the traditional financial world. The structure is very simple. Each stablecoin token issued to the market is backed by exactly 1 unit of USD or equivalent assets, usually T-bills, short-term bonds, etc. deposited in a bank. That's why organizations like Tether with us, Circle with us, or previously Binance with BIS chose this model to build trust. The biggest advantage of fight-back stablecoins is that they are easy to understand and integrate. They operate almost identically to cash and banking apps, stable with low volatility, and compatible with current accounting and banking systems for businesses. This is a safe bridge solution between crypto and traditional finance. However, the price to pay is centralization, because they depend on custodial banks. Assets can be frozen, accounts can be controlled, and the right to issue belongs entirely to a specific organization. For those who believe in decentralization, this is a significant limitation too. Stablecoin is collateralized by other crypto assets. Unlike stablecoins backed by fiat currency, crypto-backed stablecoins are fully collateralized by crypto assets like us and operate directly on the blockchain without needing banks or custodial organizations. This is the preferred choice of those who believe in a self-sovereign financial system where everything is coordinated by smart contracts and users control their own assets. A typical example is the DAI token from the MakerDAO project. Users collateralize FN1V. The system will issue DAI according to a high collateralization ratio, usually 150%, to create a safety margin when wanting to withdraw. Users only need to repay DAI along with a small fee, but if the price of it drops sharply, the system will automatically liquidate the collateral. To maintain the safety ratio, crypto-backed stablecoin is offered decentralization, but their stability is only firm as long as the market maintains balance. When the collateral assets start to plummet, confidence in the stablecoin also faces the most severe test. 3. Algorithmic stablecoins. If fiat-backed places trust in banks, crypto-backed places trust in collateral assets, then algorithmic stablecoins place trust in algorithms. Though collateral needed, they maintain price through supply and demand adjustment mechanisms, minting more when the price is high, burning supply when the price is low. A model that sounds perfect in theory but in reality is a completely different story. The Terra US project is a prominent example and also a classic collapse. The US stablecoin came with a second token called Luna, which acted as a buffer to absorb volatility when US lost its peg, for example, was 98 cents. Users could exchange 1 US for 1 US worth of Luna. The difference in to incentivize users to buy US to exchange for Luna, thereby increasing demand and pulling the price of US back to the 1 US mark. Conversely, if US exceeded its value, for example rose to 1.2 US, users could exchange 1 US worth of Luna for 1 US and then sell it on the market for profit. In theory, this was an arbitrage mechanism to perfectly stabilize the price, but everything was based on the belief that Luna had real value when US started to lose its peg. In May 2022, the market panicked. Everyone rushed to exchange US for Luna to withdraw from the system. The system responded by minting Luna without limit to meet the withdrawal demand, hoping to pull enough US out of the market and bring the price back. The result, demand for US did not recover while the supply of Luna exploded, leading to hyperinflation. The price of Luna went almost to zero. Both tokens plummeted together within days, causing over $40 billion in market value to evaporate. The Terra collapse was not just a technical accident but also a valuable lesson for the crypto industry. A model, however logical on paper, without a solid financial basis, and user trust will collapse with just a slight slip. Since the incident, almost all similar models like Ample basis, Cash war, neutrino of waves have faded away, giving way to more cautious and practical approaches. Behind each type of stablecoin is an ideology. Do you believe in the government, in crypto, or in algorithms? But no matter the model, all are trying to solve the same problem, creating a stable unit of value that can move globally without relying on the traditional financial system. And as stablecoins become more popular, the very question of who should have the right to issue money is becoming more blurred than ever before. The silent explosion. They are not as noisy as big and hitting highs, nor as exciting as us exploding, but while the entire crypto market has gone through cycles of frenzy and collapse, stablecoins have quietly developed in a different direction, silently, steadily, and extremely practically. In 2024, the total trading volume using Stablecoin has reached $32.8 trillion, surpassing even Visa and accounting for over 50% of total on-chain activity. Nearly 200 million wallet addresses have used stablecoin as the total market supply reached $235 billion, equivalent to 1.1% of the total SM2 money supply. And the majority of that, about $142 billion, belongs to a familiar name, Tether. This is no longer a tool solely for DeFi enthusiasts. Stablecoins have now become the real digital dollar, serving everyone from small retail traders to cross-border businesses to people in developing countries. Stablecoins are not just a technology, they are a practical solution to a host of problems left behind by the traditional financial system, especially for those on the fringes of globalization. In developed countries, you can use a Visa card to pay for a cup of coffee, but in Lagos or Buenos Aires, keeping a $1 bank account is a luxury. There, people don't invest in crypto, they simply find a way to hold. And stablecoin is the most feasible option. No paperwork, no bank needed, just an electronic wallet. In Turkey, where inflation exceeded 70% in 2022, stablecoin became a common way to preserve value. In Nigeria, people use USD as the main currency in online transactions, and in Argentina, a country with strict capital controls, stablecoin opens a way out of the limited banking system and plummeting local currency. But stablecoins are not just for individuals in international trade, they are being used as a new payment layer. Imagine a company in the Middle East selling goods to a customer in Asia. Instead of waiting for bank confirmation, facing exchange rate risks, intermediary fees, and cumbersome procedures, they can transact instantly across borders without going through a central bank. In 2024, Tether funded an oil deal worth $45 million exactly that way, fast, simple. In the DeFi sector, stablecoin is the blood flowing through the ecosystem. They are the unit of account, the collateral, the means for lending, borrowing, payment, staking, providing liquidity, and even farming. The fact that you can participate in a financial product, receive interest without a bank or paper contract, that is the magic that DeFi and stablecoin have created together. And then there's another less mentioned area. Remittances. Over $800 billion per year is sent by overseas workers to their families with an average fee of 6 to 8% per year. Tens of billions of dollars are lost to intermediaries like Western Union. Stablecoins with instant transfer time and almost zero fees are the ideal solution, not in theory but already happening, especially in Africa and Southeast Asia. In summary, stablecoins are entering daily life not through policy or propaganda but through usefulness. If there's one reason why stablecoins are noteworthy, it's not just because they do what traditional money does, but because they do it better, faster, cheaper, and more compatible with modern life. You can send a stablecoin over Ethereum in about 12 seconds. That number may not be impressive to Web2 users, but it's still elite compared to international banking systems. And if you transfer via Tron, the speed is only about 3 seconds, and if you use Plasma, a new blockchain designed specifically for stablecoins, the transaction is completed in under 1 second with zero fees. In addition, another name is gradually asserting its position in the payment sector. ADOS with extremely fast processing speed, low latency, near zero transaction fees, and smooth user experience. Aptos is becoming the ideal place for real-time financial applications to run. It's no coincidence that their slogan is "Money moves better on." Aptos. Compare that to the traditional financial system. SWIFT can take up to 5 business days to process a cross-border transaction. Visa and PayPal still rely on a percentage-based fee model, a model not friendly to small transactions. Even Visa in 2023 processed 276 billion transactions, but the average value per transaction was only $54. Stablecoins are different. In 2023, the number of transactions was only 2.6 billion, a small fraction compared to Visa, but the average value per transaction was $4,200. This shows that stablecoins are currently operating at a different layer, where users are no longer just individual consumers but are handling significant cash flows, commerce, investment, capital transfer. They are not widely used for bowls of pho or morning coffee, but they are shaping the standard for transactions requiring speed, stability, and low cost. And like any technology based on networks, the internet, phones, or social media, the more users stablecoin has, the faster the surrounding ecosystem develops. As more people transfer money using stablecoins, more merchants start accepting them as a form of payment. Many electronic wallets integrate stablecoin into their default interface. Many daily applications, central exchanges, cold wallets, hot wallets, etc., build products around them, and each step, no matter how small, helps reinforce the belief that stablecoins don't make anyone a billionaire overnight. They don't promise 100x returns, but what they're quietly doing is rebuilding the Infrastructure of money line by line, transaction by transaction, use case by use case. The first cracks when stablecoins are no longer stable. Every new technology must go through a testing period. For stablecoins, the shocking event came in May 2022 when the Terra ecosystem collapsed. Details of this collapse can be found above or in another video we've made in the past. The consequence was not just a massive withdrawal, it was a crack in trust. Stablecoin, which was seen as safe, was no longer invulnerable. The question was raised, are any models truly safe? Who is watching after the Terra collapsed? The stablecoin market lost its initial innocence. The feeling that everything would eventually self-balance if designed cleverly enough suddenly became too fragile. What was once considered groundbreaking algorithmic supply adjustment mechanisms, market regulation without collateral, now became living proof in a painful lesson: trust cannot be programmed. One of the most significant turnarounds came from Maker, DAO itself, the system that issues DAI, the leading decentralized stablecoin at the time. It was proud that it was fully collateralized by crypto assets without needing to rely on dollars or traditional banks. But after the storm of confidence in 2022, DAI gradually softened, first by accepting ICE as collateral, then integrating as treasury bonds, titles, and currently up to half of the DAI supply is backed by traditional assets. Decentralization has now become an ideal adjusted to reality. On the legislative front, the Terra collapse was like an alarm bell that couldn't be ignored. In the US bills like the Stablecoin Regulation Act were introduced to strictly control how stablecoin issuers operate, requiring reserve transparency audits and in some cases limiting circulation size. Europe quickly passed a comprehensive legal framework for digital assets, including stablecoins with clear standards for liquidity and stability. The market also self-corrected. Confidence in algorithmic stablecoins almost completely evaporated. Names like Basis, Cash, or Neutrino of Waves, which were once seen as big plays in DeFi, now faded into oblivion. No one is interested in models that only rely on pure technical mechanisms without a basis in real value. But the strange thing is, stablecoin didn't die. Instead of collapsing, they adapted, and it was in that chaotic period that a new generation of stablecoins began to take shape. More realistic, more flexible, and more mature. Fightback stablecoins like us no longer avoided the auditing story. They actively published reserve reports, collaborated with large accounting firms to ensure that each token is backed by real assets. Meanwhile, crypto-backed projects also adjusted their strategy. Maker no longer expects to build a system completely separate from traditional finance, but aims for a hybrid model, leveraging both the liquidity of real assets and the automation of data. Even new algorithmic models, if they still exist, follow a more modest approach, focusing on limiting risk instead of promising perfection. No longer were there 50-page white papers full of macroeconomic algorithms drawn up by programmers lacking financial experience. The dream of completely decentralized money is not abandoned, but it is viewed with a more sober eye, and like any other refining stage in technology, what is blown away by the storm are usually the models lacking substance. The rest of stablecoins that understand their position, risks, and role are the foundation for the next chapter, the last mile of currency. The remaining bottleneck: stablecoins can move instantly on the blockchain across borders without going through the banking system with near zero transaction costs. But when stablecoins reach real life, meaning when you want to withdraw money, buy goods, or use them as cash, all the complexity begins to show. The financial world calls this the last mile, the final stage where digital value needs to be converted into real-world use value. Although the technology is ready, the user experience is still limited by infrastructure and legal bottlenecks. In many countries, withdrawing stablecoin into cash is still a multi-step journey requiring an exchange account, identity verification, intermediary bank partners, and all these factors were never designed to serve a smooth experience. That's why, even though your eyes from your wallet in Texas can be sent to your girlfriend in Spain in seconds, your girlfriend still can use that money to buy 100 spring rolls unless there is an exchange supporting it or a suitable local conversion service operating. When the transaction scale increases, the problem becomes clearer. A business wanting to withdraw millions of dollars in stablecoin to pay salaries or make international payments may encounter layers of bank procedures, national restrictions, or even be refused transactions simply because they are related to crypto. The international banking network is still fragmented. Each place has its own rules. Each organization has a different level of willingness to deal with digital assets. Stablecoins can move across borders, but the financial system is not so easy to change. In addition, there is the legal factor. In many countries, stablecoin is not banned but also not welcomed. Governments worry that stablecoins are neutralizing capital controls, which are important tools for regulating money flows and maintaining exchange rate stability. This leads to tightening policies such as restricting international transfers, blocking credit cards used to buy, or not granting licenses for exchanges supporting fiat off-ramps using stablecoins, a typical example being. The result is that stablecoins operating smoothly in the digital space, when they step into the real world, they're still blocked by legal fences, incomplete infrastructure, and the trust gap between the old and new systems. That is not a failure of technology, but a reminder that a true currency revolution to take shape requires not only code but also connection with lost infrastructure, and most importantly with people. When the majority meets infrastructure, the real foundation for the new currency. Although there are still many bottlenecks, Stablecoin holds a weapon that very few financial tools have ever had: the network effect. Just like WhatsApp became indispensable with friends, colleagues, and family all used it, Stablecoin becomes stronger and stronger as the number of users increases. Each new user doesn't just add a transaction but also increases the utility for the entire network. Merchants begin to accept Stablecoin, electronic wallets integrate Stablecoin as a matter of course. DeFi applications build products around it, and digital asset issuers begin to price things in Stablecoin. Tom Blomfield, co-founder of digital bank Monzo, once said, "Every new user makes the product better for old users." This is also known as the network effect, and it is absolutely true when we talk about the Stablecoin market picture. But there is one thing few people talk about: the network effect only works if the infrastructure can handle the load. Imagine you live in a neighborhood and all your neighbors switch to using a new type of money, but the nearest is 50 kilometers away. The electronic wallet constantly has errors, and every time you transfer money, it costs high fees. The network may be growing, but if the infrastructure doesn't upgrade in time, the growth ironically becomes a burden. And that is why after the Terra crash, those who truly understood the importance of Stablecoin no longer focused on financial products but began rebuilding the infrastructure from the base layer. Ethereum, the birthplace of most stablecoins, gradually revealed its limitations in cost and speed. Tron stepped up as a popular fast and cheap option, accounting for over 69% of global transactions in 2024, but trading decentralization for performance makes many people hesitant. Some new generation blockchains like Aptos are offering a different direction with parallel architecture and the Move programming language. Aptos allows processing tens of thousands of transactions per second with near zero latency and fees of only a few cents. The transfer experience is so seamless that users can hardly tell the difference between sending $5 or 5 million. It's no coincidence that the Aptos community chose the slogan, "Money moves better on Aptos." In parallel, some new infrastructures are being built specifically for stablecoins. Plasma size on Bitcoin is a typical example. Transactions in under 1 second, zero fees, pegging state to Bitcoin to ensure security and compatibility to support DeFi applications. Additionally, there are grow-up like Arbitrum, Optimism on Ethereum, based developed by Coinbase or Solana, where Stablecoin plays a role as fuel for the entire gaming, deepen, and decentralized social network ecosystem. All of this is leading to one clear point: stablecoins are no longer standalone tokens. They're an infrastructure layer, a base layer service requiring to be served by its own ecosystem, its own design, and its own vision. And if Stablecoin is truly the dollar of the internet, their home cannot be a makeshift solution. They need a home that is strong enough, optimized enough, and open enough to welcome hundreds of millions of future users. The race to build Stablecoin infrastructure is not as noisy as the bull runs, but that is where the digital financial order of the next generation is quietly being shaped. Payments are long-lived payments. If Stablecoin teaches us anything, it's not that currency needs to be replaced, but that it needs to work better. We cannot deny the role of the traditional financial system. It has served the world for centuries, but the world has changed. We're living in an era where data moves instantly, people connect across borders, and the economy is no longer confined within the borders of a single country. In this context, how money moves also needs to be redefined. Stablecoins emerged not to overthrow but to supplement. They are not a perfect solution, but are gradually proving that value transfer can happen faster, cheaper, and fairer. And more importantly, they expand financial access to groups of people who were previously excluded, not because they didn't need it, but because they were never given the opportunity. Of course, there are still many debates about legality, stability, system security, but debate is a part of evolution, and what we are seeing step by step is the formation of a new financial infrastructure layer, where Stablecoin is not just a convenient tool but also the foundation for a global digital value system. Payments at long payments is not a declaration but a transition from what is old and outdated to what is gradually becoming more suitable for the era, and Stablecoin is very likely the bridge in that transition. Hope you enjoyed this video. Don't forget to like, share, and subscribe to support us.